everyone, welcome back to Mindful Investing. Today's video is all about ETFs, how to choose the right ones, how to handle market crashes, how to dollar cost average strategically, and how to find key support levels using Robinhood and ThinkorSwim. If you are someone who's planning to invest in ETFs or already building an ETF focused long-term portfolio, this video will be extremely helpful. So please watch till the end. I'll also share some support levels for top ETFs like SPY, VOO, VTI, VGT, and QQQM, and walk you through the mindset that help you stay consistent through all market cycles. With that said, let's get started with the most important topic in this entire video. What should we be actually doing during market crashes or recessions? How do we split our money? How do we dollar cost average? And most importantly, how do we stay mentally stable when everything around is red? Because the truth is, when markets fall, most retail investors make the same two mistakes over and over again. They either panic sell or they freeze and do nothing. Now, between these two, selling is actually the lesser problem. At least you took some action. But doing nothing, just sitting there scared, that's what costs people the most. Because while you are frozen, the wealthy, experienced investors are quietly buying at discounted prices. And this happens because when you see markets falling every single day, when every headline screams recession, inflation, AI bubble, or crisis, your brain naturally thinks, what if it drops even more? What if this time is different? But if you zoom out and look at the history, it's never different. Like dot-com crash, housing crisis, COVID crash, geopolitical tensions, tariffs, debt ceiling dramas, every single one of these events felt scary in those moments. And yet, every single time, the market recovered and pushed to new highs. And who benefited the most in all these events? Not the people who waited for the perfect bottom, not the people who tried to time the market, not the ones who froze. It was the people who bought consistently, especially when the market was at its lowest. And this is exactly why my focus with ETFs is simple. Accumulate more and more shares during drawdowns because 10 years from now, this approach will massively outperform panic selling or trying to guess the bottom. Here's how I personally do it. Right now, I have 4 ETFs in my public portfolio. Those are SCHG, SCHD, JEPQ, and IBIT. On SCHD and IBIT, I'm doing a 15-year challenge. I put $50 per week into each, no matter what the market is doing. Green, red, sideways, the money goes in automatically. And on top of that, whenever these ETFs drops below their 50-day or 200-day EMA, I add an extra 20 to 50 shares because I'm investing for the long term. And long term investing is about share accumulation and not timing candles. And if you are following this challenge with me or planning to start, please comment below. I'll be very happy that I was able to motivate you and will be happy to hear your investing journey. All right. There's actually another advantage of ETFs compared to individual stocks, which is you don't need to worry about earnings report, CEO changes, bad quarterly guidance, or macro conditions. ETFs hold a basket of stocks. They are diversified, they are managed by professionals who rebalance the portfolio, remove weak companies, and add stronger ones. So, even if you had 100% of your portfolio in ETFs, you could still sleep peacefully at night. Your long term returns will average out to 10 to 15% annually over a decade or more. And my goal personally is to use the money I make from my individual stock trades, whether swing trades or long term trades, to fund my ETF portfolio. Because I don't want to spend my entire life monitoring every single piece of news. As I age, I want stability, I want peace of mind, and I want my money compounding quietly in the background. That's the mindset you need to develop. And it's honestly the hardest part of investing. All right, now that we have talked about mindset, let's move into the practical side. How do we actually choose the right ETFs? Because there are thousands of ETFs out there and it's easy to get overwhelmed. The first thing I look at is the expense ratio. This is basically the fee you pay every year for the ETF to manage your money. Lower is always better, especially for long term investors. Over 10, 15, 20 years, even a small difference compounds massively. For example, in the dividend category, I chose SCHD. It has an expense ratio of just 0.06%, which is extremely low. It manages around $69 billion in assets and holds 103 companies. That tells me it's well managed, diversified, and supported by a large investor base. Next, you need to look at long term returns For examples, SCHD has delivered around 11% annual return over the last decade, and that's excluding the dividends you receive. With dividends reinvested, the total returns are even higher. But here's the key point. Don't get carried away with the crazy returns we have seen in the last few years. The S&P 500 doubled in just last 5 years. That's not normal. Even many professional fund managers struggle to consistently hit 20% annual returns. And if you zoom out to 15 or 20 years, you'll see most major ETFs and indices average around 12 to 15% annually. That's the realistic goal. That's what you should expect, and that's what you should plan around. So, when you're choosing an ETF, look for three main things: low expense ratio, strong long term performance, healthy diversification, and large assets under management. That's it. Don't complicate it. You don't need 20 different ETFs. Two or three high quality ones are enough to build serious long term wealth. All right. Now, let me show you my buying strategy because this is where most people get it wrong. And my approach is very simple. I buy heavily during pullbacks and then I sit back and enjoy the ride when the ETFs are trending up. But what I've noticed is that a lot of investors do the complete opposite. They chase green candles and then panic on red days. That's the habit that destroys long term returns. And here's something I want to make very clear. Please do not sell your ETFs during drawdowns. Trim individual stocks if you want, move to cash if something feels risky, that's completely fine. But ETFs are designed for the long term. They are diversified, they rebalance, and they recover faster than some individual names. When they drop, that's when you add. Let me give you a practical example. Let's say you have $10,000 ready to invest. Here's exactly how I would plan my entries. If the ETF drops below the 50-day EMA, I deploy $3,000. If it dips below the 200-day EMA, I deploy another $5,000. That way, I'm leaning into weakness, not chasing strength. And remember, these deeper pullbacks don't happen every month. When they do, that's the moment you want to step in aggressively. And another important thing most people forget is if we truly want to build long-term wealth, we can't rely on a single lump sum amount saying I only have $10,000 right now and I cannot bring in more, because this doesn't work. We need to constantly bring in money from wherever we can: side incomes, bonuses, savings, because the best wealth building opportunities happen during fear, not in euphoria. Let me give you a perfect example from my own portfolio. My SCHG ETF position, which I started this year, is up 30%, even though year to date SCHG itself is up only 15%. And this extra 15% came from the strategy I'm talking about. I bought aggressively during the April tariff correction when everyone else was scared. That single move doubled my returns, and I'm planning to keep doing the same exact thing on every 5 to 10% pullback for the next 10 to 15 years. This approach maximizes returns at multiple points and compounds your wealth far more effectively than waiting for the market to feel safe. Alright, now let's break down how to identify support levels on charts. You don't need to be a technical analyst or use 50 indicators. Support and resistance are actually very straightforward concepts once you understand what you are looking at. Let's simplify it. Support is a price level where buyers historically step in. When the stock reaches that level, demand increases and the price tends to bounce. Resistance is the opposite. It's a level where sellers show up, supply increases, and the price struggles to move higher. Think of support as the floor and resistance as the ceiling. The price bounces around between those levels until it finally breaks through. Now, when you're drawing support levels, here are the key rules. You need at least two swing lows. This means two separate points where the price dropped, touched a level, and bounced. Once you have those, you connect them with a horizontal line, just simple as that. When looking for confirmation, pay attention to the candles. Candle bodies that bounce multiple times off the same zone indicate a support zone. Wicks also matter. They show where buying pressure came in even during intraday volatility. Now let's look at this in practical in Robinhood. Robinhood has actually gotten better with charting, but it's still basic. Here's how to make the most out of it. You need to first go into Robinhood Legend and then select the 1 year time frame. Change the interval to daily. Click on lines and then select horizontal line. Now connect at least two swing lows to establish a support zone. This will give you short-term support levels. For long-term levels, switch the interval to weekly, select 5 years or all, This helps you see the bigger picture where the stock has historically found support over multiple market cycles. Those long-term levels tend to be stronger and more reliable. Now, personally, I prefer using ThinkorSwim for technical analysis. I've been using it for many years and I've built preset layouts for both daily and weekly charts. That way, I don't have to add indicators every single time. Everything is already ready to go. But the concept is actually the same. Whatever you use, Robinhood, ThinkorSwim, TradingView, or even Yahoo Finance, the core method doesn't change. You are simply identifying levels where price reacted before and mapping them so you know when to buy during pullbacks. And this ties perfectly into what we have talked about earlier. Knowing your support levels help you plan entries with confidence instead of reacting emotionally. Alright, now let's put everything together and look at some of the actual support levels I'm tracking right now for some of the top ETFs. These levels are based on both daily and weekly charts, combining short-term structure with long-term trend zones. Here's what I'm actually seeing for SPY. 611 is the first strong support zone. If SPY breaks below 611, the next major area where buyers historically stepped in is around 574. And if that level fails, the deeper long-term structural support sits near 478. And next, for VOO, $560 is the first solid support area. If VOO slips below 560, the next support zone is 468, where we have seen significant buying before. Below that, 441 becomes the next major level. And if macro environment worsens, 377 is the deeper support. And the long-term structural floor sits at around $349 based on weekly data. And for VTI, 302 is the immediate support zone. If VTI breaks below 302, the next major long-term support level is around $250, which has held strong during previous corrections. And for VGT, $647 is the nearest support area. But if VGT falls below 647, the next major demand zone appears around $457, which is a strong long-term support based on multi-year price action. And for QQQM, $222 is the first support level. If QQQM breaks through $222, the next significant long-term support sits near $166, where buyers came in strongly several cycles ago. Now, before anyone gets shocked seeing these deeper levels, let me repeat something important. Some of these are major long-term support zones and they only show up when you zoom out to weekly time frames. These aren't levels you expect it to hit every month, but when the market does pull back hard, these are the areas where historically buyers have stepped in aggressively. Your job as an investor is not just to know these levels, it's to validate them yourself. Draw them on your own chart, watch how price reacts around them and plan your entries based on your time horizon and risk tolerance. Support levels are not predictions, they are just tools. Use them to build conviction and structure around your buying strategy, not to chase momentum or react emotionally. And that wraps up today's deep dive on ETFs, how to choose them, how to buy them during pullbacks, and how to chart your support levels with confidence. If you want a dedicated tutorial on ThinkorSwim, how I set up my daily and weekly layouts, which indicators I use the most, just let me know in the comments below. I'll be happy to break that down in separate video. But here's the key takeaway I want you to leave with. Markets don't go up in straight lines, they move in cycles. Fear, euphoria, corrections, and recoveries. The investors who consistently build wealth are the ones who stay patient, stay disciplined, and keep buying quality assets during the red days when everyone else is panicking. That's how you take advantage of volatility, not run from it. That's it for this video. Thanks for watching, and as always, stay patient, stay safe, and invest mindfully. I'll see you in the next one.